Okay, let's unpack this. This week, we're diving into a fascinating market analysis that paints quite a picture of our global financial landscape right now. It's this peculiar balance, isn't it? Optimism, but also quite a bit of uncertainty.
Yeah, it really is. And what's fascinating, I think, is how last week's powerful rally,
Hmm.
which was, fueled by all that optimism about a potential September rate cut from the Fed, well, now it's about to face some pretty serious tests.
Tests like what?
We're looking at high-stakes geopolitical events and, crucially, some pivotal inflation data. So for you, we're going to explore what's immediately ahead, highlight those big risks, and maybe try to understand why the market seems, well, remarkably calm despite it all.
Okay, so where should we start? What are the big sort of drivers this week?
Well, it really boils down to three major narratives, I'd say. Three things set to define market action.
Right.
First up, the tariff tightrope. Tuesday is the critical deadline for that 90-day truce in the U.S.-China trade dispute.
The market expects an extension, right?
Mostly, yes. Participants seem to have priced that in, but, any deviation, especially if tariffs escalate, that could really provoke a sharp jump in volatility.
Hitting tech and industrials particularly hard, I imagine.
Exactly. And you add to that President Trump's recent comments sort of warning the judiciary about interfering with tariffs. It just highlights the political stakes involved. It's really high stake.
Yeah, definitely. Okay, what's the second narrative? You mentioned geopolitics.
That's right, the geopolitical gambit. On Friday, there's that scheduled summit in Alaska between President Trump and Russian President Putin.
And the speculation is all about Ukraine.
Widespread speculation, yes, about a potential peace framework. And you can already see the impact. There's downward pressure on defense stocks in Europe, for example, and global crude oil prices are feeling it too. West Texas Intermediate is trading lower, around, $63.40?
Because of possible sanctions relief for Russian energy?
Precisely. That possibility is definitely weighing on the market. It could really alter the global energy picture.
Okay, tariffs, geopolitics. What's the third one?
The big one, the inflation litmus test. Look, the market has this deep, profound conviction that monetary easing is coming.
The September rate cut expectation.
Yeah, the CME FedWatch tool is showing almost like an 89% probability of a 25 basis point cut in September. It's huge. But that conviction is going to be directly challenged this week.
By the CPI report on Tuesday.
Absolutely. That U.S. Consumer Price Index report. It is, without a doubt, the most critical economic release of the week. Consensus is looking for headline up 0.2% month over month, core up 0.3%. Pretty mild.
But if it comes in hotter?
Well, that's the risk. An unexpected jump in inflation could force a really violent repricing of interest rate expectations. You could potentially get this nasty stagflationary shock, slowing growth plus rising inflation. The market is absolutely not priced for that right now. And then we also get the producer price index, the PPI, on Thursday, another piece of the puzzle.
Okay, so with all that looming, how are things looking sentiment-wise? U.S. futures are kicking off the week, especially after that NASDAQ record high last week, above 21,450.
It's a cautious start. A mixed open for U.S. stock futures, actually. And here's something interesting. The VIX, the volatility index, it finished Friday pretty low, around 15.15.
Low, despite these big risks you just outlined.
Exactly. It seems maybe complacent. It feels kind of incongruous with these two major binary risk events lined up for the week. It really suggests the market might not be adequately pricing in what we call tail risk, those low probability, high impact events.
Complacency. Okay, let's zoom in on some specific sectors. These reports about a new tech tax. What's that about?
Yeah, these are unconfirmed reports, mind you, but they suggest chip makers like NVIDIA and AMD might have agreed to pay the U.S. government like a 15% share of their AI chip revenue from China.
In exchange for export licenses.
That's the idea. It's a really novel arrangement. It could basically function as a new kind of tax on tech companies operating in China. If true, it could force a fundamental repricing of semiconductor stocks that have significant China exposure. It's a potentially big shift.
Wow. Okay, shifting gears.
Yeah.
Lithium seems to be having a moment pre-market.
Big moment. It's a major supply-side shock that's really igniting that subsector. CATL, the huge Chinese battery maker, the world's largest, has reportedly suspended production at its big Yichun lithium mine.
And that mine is significant.
Hugely significant. It accounts for something like 3% of the entire world's forecast lithium output for 2025. Just one mine. So you're already seeing shares of major producers like Albemarle indicated up, over 7% pre-market? It shows how fragile these critical material supply chains could be.
Definitely something to watch. Okay, one more. The trade desk, TTD, Huge drop last Friday, nearly 40%. What's the story there? A fallen angel.
Yeah, it's definitely being called that, a fallen angel. The drop was catastrophic, no doubt. But interestingly, the Wall Street consensus seems to think the reaction was maybe overdone.
Really?
The median price target still implies about 48% upside from where it is now, and the company still has incredibly high customer retention, over 95%. So it's shaping up to be a real battleground stock for tactical investors maybe looking for an opportunity.
Interesting. Okay, let's pull back. Bigger picture.
Well, connecting the dots, the week ahead is really defined by this precarious balance. You have this powerful bullish momentum in the market, right? But it's built almost entirely on expecting the Fed to stay dovish. And those assumptions, they're fragile. They're about to be severely tested.
And the low VIX adds to that precarious feeling.
It's a significant warning sign, I think. It suggests this recent rally might be quite mature, maybe vulnerable to a negative shock.
Okay, so wrapping this up, what does this all mean for you listening in? Well, given how dense the high-impact event risk is, maybe a neutral, slightly defensive posture makes sense to start the week. Just, see how things unfold. But also remember, these events, they could create some major market dislocations.
Opportunities.
Right. If there's a broad sell-off triggered by a negative shock, that could present some attractive entry points, in fundamentally sound companies that just get beaten down temporarily. Strategic agility is going to be absolutely paramount for you this week. So here's something to mull over as we finish. How might these big geopolitical shifts, these economic changes, how might they directly influence the things you buy every day, or the job market, or even, the long-term outlook for your own financial planning? Something to think about.